Markets looking up. Tech stock value, we've been talking about it, sky high, but earnings not so fast. Analysts predicting the second quarter is going to see earnings drop 6.4%. That's according to data from FactSet. This as the stock price of S&P 500 companies continues to soar, hinting at a disconnect perhaps between valuations and the actual worth of the market's leading companies. We're bringing back Gargi Chaudhuri, BlackRock's head of iShares investment strategy. I always struggle with the earnings outlook. I have to admit, Gargi, because it tends to be wrong, the big picture, right? The last few quarters, we've predicted declines, and the declines have been much smaller than anticipated. So what's going to happen this time around, and what does it tell us about valuation?
Yeah, so I think especially the last quarter, I think that's one of the big reasons that we have seen such a rise in the markets, such a almost unloved rally, if you will. Especially when you think about how people were positioned coming into the year. And we spend a lot of time looking at sentiment and positioning and flows. And certainly investors want, sort of as an overweight equities as they want it to be. Now, we had that big surprise last quarter. This quarter, again, I'll tell you what we're looking at as it pertains to earnings data. But to your point, it's hard to know. What I will say is that, and this is why we remain a little bit more cautious in our stance, I think that we haven't seen the full impact of the 500 basis points of rate rises that we've gotten so far. I think that's yet to come in the markets across industries. I think it's yet to come across companies when they're talking about their or viewing their profitability. And then if we think that we might get even 2 more rate hikes after this, which is kind of what the market is at this point expecting. Again, monetary policy works with a lag. So is this the quarter where we have a massive undershoot based on what the analyst expectations are? Maybe, maybe not. But is there a quarter, like if that's Q3 or Q4, where we are going to see that slow down? I think so. I think there's been enough data points that have shown us that this economy is very resilient. Absolutely. No doubt about that. I was certainly in the recession camp myself for 2023, and that hasn't been right. But I do think that as we look into 2024, and I don't want to speak too much about this quarter in terms of it being stronger or weaker, but I do think as we look further out, I think there will be that impact of profitability, of margin resiliency as it pertains to still high inflation and high rates and labor markets being very, very tight, and the impact that will have on companies' profitability.
We've already seen a few levers that companies have needed to pull, even in advance of concern about a larger macroeconomic downturn that is more severe. And it's been on the restructuring front. It's been on, passing on or in the profit preservation front, in passing on costs to their consumers or even raising prices as well. What is the lever that they still have available to pull in this earnings period that they're going to have to forecast or at least disclose to the street?
Yeah, and I think exactly to your point, we've already seen some companies, and we call these quality companies, and we tell investors to sort of gravitate towards quality with tickers like QUAL. We tell investors to do that because some companies have been able to preserve their margins. Some companies have been immensely profitable. Some companies have been able to restructure, right size. Think back to the hiring practices they had in 2020, 2021, perhaps even 2022, and maybe many people sort of kept their workforces because and are probably still doing so because it was so hard to find labor, and then recognizing that the environment, the regime has shifted, and now we need to make some difficult decisions about the size of our workforce. And they've done that. Luckily for those impacted, it's a strong labor market, and we haven't really seen that pick up in initial jobless claims. So coming back to your question, though, what are the levers that companies that they still have? I mean, I would say playing their balance sheet to their advantage, taking advantage of rates when they can. I would say looking at ways that they can continue to be profitable, whether that is on the restructuring front. I would also say a lot of companies are rethinking around reshoring, supply chain resiliency. That's something that is definitely a focus of mine for this earnings season. I would also say ways to boost or enhance productivity. And I know we just had the AI conversation, but that's not the only way you can enhance productivity. What are the other ways that you're getting more out of in a pretty cost-constrained environment?
So, Gargi, when it comes to equity allocation right now and where people should go in this environment, you guys are talking defensive, and you mentioned one of those, QUAL, I think. Energy, I think, is one of the other areas you're looking at, which is
interesting.
We're not hearing that so much.
You're not hearing that at all. So glad you asked this question. The way we're thinking about this is that broad equity markets are certainly priced to perfection. Right? And I know we were talking about this earlier as well. And yes, some of that has been because of data resiliency. But if you think about the forward earnings growth at close to 6.8% right now, if we do slow down, does that materialize? Unlikely. So equity markets priced to perfection, but there are pockets that investors can benefit from, right? And you should always remain invested. So what are those pockets? Number one, certainly quality. Number two, if you are in the camp where we are, which is a little bit of a cautious stance, then reducing your risk, reducing your volatility with something like a USMV, which again gives you sector neutral, broad allocations to the markets, but in a lower beta, so a lower or a higher downside capture. So if the market's going down, you're not going down as much. And then, I talked about this price for perfection outcome, but if we do indeed have a soft landing, a few sectors have certainly priced for a hard landing, and energy is one, which has priced for a hard landing, but obviously there are other sectors that have not. Some have priced for a soft landing, some have priced for a hard landing. So if we believe that everything's fine and we're going to have a lower than output, a lower output than neutral, but at the same time, we're not going to have a recession, then that's where energy is like one of those, we like to call it quality at a reasonable price, high cash flowing part of the market that still is reasonably priced. So again, not if you're expecting a recession, that's not where you go for the energy company names. But if you think, it's sort of like choose your adventure, if you think that this is going to be an economy that remains resilient, that we will slow down, we'll have a period of below sustained growth, but not recession, then energy companies might be that one to benefit the most.